Not many people are as well known in the world of business as Warren Buffett. The financial advice of Warren Buffett, who is often called the Oracle of Omaha, has helped a huge number of people. But even Buffett, who has decades of experience and billions of dollars, knows that making mistakes is a normal part of business. By using what he has taught us, buyers can avoid common mistakes. Based on what Warren Buffett says, here are 10 mistakes that all investors make. 10. Not getting enough information. One of Buffett's main ideas is that you should know what you're investing in. He is known for telling people not to invest in companies they don't understand. Still, a lot of investors jump into hot stocks or sectors that are popular without doing enough research first. Weak due diligence like this can cause people to make bad business decisions. Buffett reads annual reports for the companies he invests in for hours on end to stay up to date on them. Before making any investment choices, he thinks it's important to learn a lot. In this way, he can find worth and stay away from possible problems. 9. Going after the market. A lot of the time, investors make the mistake of following market trends. People want to jump in and ride the wave when the market is rising. When the market is bearish, on the other hand, panic selling is usual. Buffett's plan is to stay calm and sensible no matter what the market does. He pushes for a long-term view and stresses that the principles of the business are more important than the market's short-term changes. It is pointless to try to time the market, and it is very important to stick to a well-thought-out financial plan. 8. Ignoring the quality of management. Buffett puts a lot of weight on how good a company's management team is. His ideal leaders are trustworthy, skilled, and focused on the needs of their shareholders. But a lot of investors only look at financial data and don't pay attention to the people who run the business. This is something that can be a big mistake. A business can get through hard times with good leadership, but even the best opportunities can be wasted with bad management. When judging management, you should look at their past performance, their vision for the company, and how well they can carry out their plans. 7. Ignoring the value of the company. Buffett is very picky about value. He thinks that good companies should be bought at fair prices. But a lot of buyers get excited about growth stocks and pay ridiculously high prices without looking at how much the stocks are really worth. If the company's growth slows down, this could cost it a lot of money. To figure out what a company is really worth, you have to look at its earnings, assets, and growth prospects. To make sure he's not paying more than the company is worth, Buffett figures out a margin of safety. This lowers the risk. 6. Spreading out too much. Many people agree that diversification is a good way to handle risk, but Buffett says that you shouldn't do it too much. He says that investing in too many things at once can lower results and cause poor performance. He instead recommends a focused investment approach that focuses on a small group of well-known companies. Investors can keep a close eye on their money this way and make smart choices. Too much variety can also make people unreliable, since it's hard to keep an eye on a lot of stocks at once. 5. Making choices based on feelings. Investing based on your emotions is a bad idea. Buffett talks a lot about how important it is to stay logical and follow rules. Fear and greed are two feelings that buyers often use to make bad choices. Fear can cause people to sell in a hurry when the market goes down, while greed can make people chase stocks that are going up quickly. When making investment choices, Buffett says not to let your feelings get in the way. This means sticking to a clear plan no matter what the market is doing and not acting on impulse based on short-term market changes. 4. Not putting dividends back into the business. Buffett thinks that profits should be reinvested. He thinks that putting dividends back into the business can greatly increase long-term profits. But a lot of investors cash out their dividends, so they miss out on the benefit of the dividends adding up over time. When you reinvest dividends, you buy more shares of the same stock with the money you get from the dividends. This makes the overall investment bigger. This can cause exponential growth over time since the dividends that are reinvested create more dividends, creating a positive cycle of returns that grow over time. 3. Not having a plan for how to leave. Every donor needs a way to get their money back. It's important to know when to sell a stock, says Buffett. A lot of investors fall in love with their investments and don't sell for too long, even when the numbers start to go down. Some may also sell too quickly at the first sign of trouble. Buffett's method involves making it clear when he wants to sell, for example, when a company's competitive situation or management quality changes. Investors can avoid making hasty choices and lock in profits or cut losses at the right time if they have a plan for when to leave the market. 2. Not realizing how powerful patience can be. If you want to spend, you should be patient. Buffett says that if you want to be a good investor, you need to think about the long run. But a lot of buyers want to see returns quickly and might get irritated if their investments don't work right away. This impatience can cause people to trade a lot, which can increase transaction costs and lower total returns. The plan for Buffett is to buy good companies and hold on to them for a long time, letting their value grow over time. He said, the stock market is designed to transfer money from the active to the patient. 1. You don't learn from your mistakes. Finally, Buffett thinks that the best way to make money with investments is to learn from your mistakes. Every owner will make mistakes. The important thing is to figure out what went wrong so you don't make the same ones again. But a lot of owners either don't think about their mistakes or put the blame on outside factors. Buffett's method is to look back at deals that didn't work out, figure out why they didn't work out, and use what he learned to make better decisions in the future. This process of learning all the time helps investors make their plans better and see longer-term gains. Warren Buffett's business advice emphasizes simplicity and common sense, guiding investors to avoid common mistakes and improve their chances of long-term success. Key principles include doing the right thing, being patient, and controlling emotions. These principles can help buyers understand the market and build a strong foundation for their future finances. Investing should be smart choices that fit risk tolerance and financial goals, and Buffett's mistakes as a trader can be improved by using his lessons to improve future plans. This is it for today. We hope you enjoyed the video. If so, then share your thoughts in the comments and also share this video with your friends. Don't forget to subscribe to our channel and press the bell icon so you can never miss our video.